Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this installment, we're going to take a look at the question, should you make your tax-free savings account contribution or your RSP contribution? So many people are in a situation where they can't do both, and they're trying to figure out which is better for them in their particular circumstances. So we're going to take a look at a calculator that you can access through our website to help you make that determination. Now, in an ideal world, you want to do both. Both accounts are very powerful. The RSP account obviously is like a pension plan. You put money in, you get a tax deduction, the money grows on a tax-deferred basis, so it accumulates down the road for retirement, and then you draw the money out. It'll be taxable at that point. But what I've experienced with many of our clients is that there usually is a drop in tax bracket. So they're actually getting a higher tax deduction when they're working, and then they're paying tax at a lower rate. So ultimately, the RSP can be very powerful. Now, the tax-free savings account, although you don't get a tax deduction or a tax credit when you put money into the account, so although you don't get a tax deduction or a tax credit when you make a tax-free savings account contribution, all of the internal earnings or growth on the investments compound on a tax-free basis. And when you take money out, it's non-taxable income to you. So again, very powerful. So let's go to our website and I'll show you how you can get to the calculator to figure out which is better for you in your circumstances, if you have to make a trade-off between both of these options. Okay, so if you go to humphrieswealthgroup.com, you're going to get to our home page. If you scroll down to the bottom of the page, you're going to get to the sort of menu bar. And if you go to Toolbox, click that, and it's going to give you some resources, but go to the online financial calculators, click that, and then it's going to take you to a bit of a menu page. Here it says TFSA versus RSP. Again, click Open Tool, and it's going to take you to this calculator. So it says at the top, TFSA versus RSP. See how your marginal tax rates affect the growth of your TFSA and RSP account. So I'm just going to go through a couple of quick examples to show you how you can use this calculator in your circumstances. So the numbers don't really matter. It's really just, I'm going to review how you use it, and then you can plug in your own numbers and assumptions. So I live in Manitoba, so I'll use province of Manitoba in the calculator. Taxable income when you contribute. Okay, so I'm going to leave this at $100,000 as my taxable income. And then here it says taxable income when you withdraw. So down the road, when you withdraw the money, when you're retired, what will your taxable income be? Well, let's say that my income is going to drop and it's going to go down to $50,000. And the contribution I'm going to make to the account, I'm going to say $10,000 in this example. I'm going to invest or spend the RSP refund. I'm going to reinvest the tax refund from the RSP. And years of growth, 25 years. I'll use 10 years in my example here. And we'll use a 6% growth rate on the portfolio. So again, the growth rate doesn't really matter. You put what you want to put in here. If you're really cautious, you might use 3. If you're a hyper growth portfolio, you might use more than 6. 6% is probably a middle of the road kind of return over time. Now it's going to give you an immediate calculation, and you can see here that in the next 10 years, which is the time period we used, the TFSA versus the RSP, it looks like the RSP has an advantage. So this calculator says that the RSP has an advantage of $1,818 per $10,000 of contribution. So you can take a factor of the 10,000. If you add in 30,000 or 40,000, then multiply that difference by 4 times. So you can see here in the calculator, it shows you the pre-tax dollars going in. Okay, so you can see on this schedule here, it has a contribution of $10,000. With your TFSA, if you've got pre-tax dollars of $10,000, then you're going to have tax of 37.9% on that income. So you'll have left $6,210 to invest. The investment value in 10 years will be $11,121. And of course, there'll be no tax on the withdrawal. So the net amount will be $11,121. If you look at the RSP account, the pre-tax number is $10,000. You don't have to worry about taxation on that because the RSP will give you a deduction. So all $10,000 will go into the RSP account. The investment value down the road will be $17,908 using the 6% growth. and then the tax will be 27.75% or $4,970. Your net is $12,939. So what you can see here is if you get the tax deduction, which we do in the RSP, and if your marginal tax rate goes from 37.9% and then you have less income down the road at 27.75% marginal tax rate, that's at $50,000 of income, the RSP will be net ahead. Now, once you do the calculation, you can then print yourself off a PDF and save the report for your file or future reference. Now, let's just take a look at the same calculation, and what I'm going to do now is I'm going to say that my income is going to be the same when I retire. So again, I've got $100,000 of income, $100,000 of income at retirement. I'm going to make a contribution of $10,000. I'll reinvest the tax refund, 10 years, 6% interest, and you can see that there's no net benefit between each of them. So if you had to make a decision on this, it looks like the two accounts are equal. So even though the two accounts look to be equal, that probably doesn't tell you the whole story. So on the surface, if you had to make a judgment call between, do I make the RSP contribution or do I make the tax-free savings account contribution, it looks like it's a toss-up. Now, on the one hand, you might defer to the TFSA because it's a very flexible account. As an example, not only does the money compound on a tax-free basis, but when you take the money out, it doesn't have any impact in terms of taxable income. So longer term for retirees, that could be beneficial when it comes to other benefits. So old age security benefits, as an example, can be subject to clawback depending on your taxable income. And so if you wanted to get access to income that doesn't trigger more taxable income, the TFSA could be a great option. On the flip side, the RSP contributions will often be used to fund retirement income, and under the current tax code, up to $2,000 of income from your registered accounts through a RIF payment is subject to a pension income tax credit. So you'll want to have some money in an RSP account to take advantage of that credit. As well, my experience has been that it's very uncommon actually to see clients deducting contributions at one marginal tax rate and then pulling the money out in retirement at the same tax rate, particularly given the fact that pension income or RIF income can be split with a spouse if you have a partner. So in most situations where there's a partner, almost always we see a drop in marginal tax rates when those couples transition into retirement. Now, for single individuals, it's different, and I think these calculations could be helpful as a way of trying to game which makes more sense for you. This calculator is especially helpful for younger folks who are saving money and they only have so much money to go around and they're trying to figure out how to allocate the money. So again, if you're at a higher income, you're a young professional, the RSP contribution, if you had to make a choice, likely is still the better option for you. If your income's more moderate and you think your income's going to be constant over the next number of years, again, if you have to make a choice, probably a TFSA would be better for you. So that concludes the discussion on, do I make the tax-free savings account contribution or the RSP contribution? Hopefully that's a little bit helpful. If you take a look at the show notes, you'll find out how you can get some additional resources to help you with your overall retirement income planning and wealth planning. And if you want to find out how you can get a complimentary retirement forecast, click the link to go back to our website, and on the homepage we discuss how you can get that forecast. Anyway, wishing you all the best as you plan for your retirement and overall wealth planning journey. You take care. Bye-bye.